How do you spot a company that is quietly suffocating and about to crash into bankruptcy within the next 12 months, even if its profit charts look perfectly fine? Before you touch any financial statement, there is one single numbers game on the balance sheet that dictates life or death for a business: the current ratio. But forget the basic textbook definitions. Today I am going to expose a massive illusion built into this metric that traps thousands of retail investors every single year. A high ratio isn't always safety. Sometimes it's a red flag of a sinking ship. Let's strip away the surface-level noise and reveal the real truth behind the numbers. Simply put, the current ratio measures a company's ability to cover its short-term obligations using its short-term assets. The mathematical formula is straightforward. Current ratio equals current assets divided by current liabilities. Current assets are resources a business expects to convert into cash within 1 year. This includes cash itself, marketable securities, accounts receivable, and inventory. On the flip side, current liabilities are debts and obligations that must be settled within that same 12-month period, such as accounts payable and short-term bank loans. Now, for a company to be genuinely stable, this ratio needs to sit comfortably between 1.5 and 2.0. This is the ultimate safety zone. It means for every single dollar of short-term debt, the company holds $1.50 or even $2 in liquid assets. When a business maintains this specific range, it possesses the financial cushion required to withstand any sudden economic storm. But here is the hidden truth that 99% of amateur investors completely miss. A very high current ratio is not always a good sign. If you see a company with a current ratio of 4.0 or 5.0, do not blindly assume it's financially bulletproof. In corporate finance, an excessively high ratio often signals severe operational inefficiency. It tells us that management is hoarding idle cash instead of reinvesting it into growth. Or worse, they are struggling to collect money from customers, causing accounts receivable to bloat. Furthermore, it could mean the company is stuck with piles of unsold inventory that nobody wants to buy. Remember, if a clothing brand or a technology manufacturer is holding on to massive stock, that inventory loses value every single day. Context is everything. You can never compare the current ratio of two different sectors. For instance, retail giants like Walmart or Costco often operate with a current ratio below 1.0. Why? Because they have immense bargaining power. They sell their inventory to customers for immediate cash, but they delay paying their suppliers for 60 to 90 days. Conversely, heavy manufacturing companies or hardware tech giants require a much larger cushion, typically between 1.5 and 2.0, because their production cycles are long and cash gets trapped easily. Let's put your analytical skills to the test right now. Imagine a tech company has $600 million in current assets and $300 million in current liabilities. However, out of those assets, $400 million is locked up in stagnant inventory. Pause this video, calculate the standard current ratio, and let me know in the comments below. Would you invest in this company based on its liquidity? Go ahead, type your thoughts. If you calculated it, the textbook ratio is 2.0, which looks great on paper. But as we just discussed, once you peel back the layers and see the inventory trap, the picture changes completely. This is exactly why in our next episode we will strip away inventory entirely and look at the quick ratio, also known as the acid test. If you want to master fundamental analysis and build institutional-grade financial literacy, hit that like button, subscribe to the channel, and I'll see you in the next breakdown. Let's build your wealth together.